University of Michigan Consumer Sentiment Index relapsed. So we're back into deep COVID and 08-09 territory in terms of this sentiment index. And it makes sense. It's that regional bank crisis. It's consumers saying, wait a minute, what's going on? Are we safe? Are we safe in our banks? That's a big one, right? And it was a big drop and a big surprise. The other thing in that report was consumers saying, I think inflation's going up. And I think one of the reasons for that was gasoline prices did go up. And the consumer is railing against price increases. And that's why we think a lot of companies are going to start cutting prices.
After weeks of negotiations and dire warnings about the looming economic catastrophe, leaders from the White House and Congress in the United States have finally reached an agreement to raise the debt ceiling. This critical agreement must now be transformed into law before the U.S. faces default on its financial obligations. The resolution of this crisis, which has been months in the making, can be traced back to the November 2022 midterm elections. During these elections, the Republicans narrowly secured a majority in the U.S. House of Representatives, thereby depriving President Joe Biden's Democratic Party of the ability to pass legislation independently. The deal, negotiated by President Biden and Republican House Speaker Kevin McCarthy, involves a 2-year suspension of the debt ceiling and a cap on government spending during the same period. Following the release of the May non-farm payrolls report, which showed a surge in employment numbers, the U.S. dollar experienced a boost in value. Meanwhile, market participants debated the possibility of the U.S. Federal Reserve refraining from a rate hike in June. The report revealed a substantial increase of 339,000 payrolls in both the public and private sectors in May, surpassing the average forecast of 190,000 by economists polled by Reuters. This surge followed a rise of 253,000 in April. In this video, Cathie Wood delves into the details of the debt deal, fiscal and monetary policies, as well as various indicators that shed light on the future trajectory of the economy. It is advisable to pay close attention to the video, as Wood effectively covers the multiple facets of the economic landscape.
Please take a moment to like this video, subscribe to the channel, and don't forget to drop your comment and observations in the comment section below. Thanks and enjoy the video.
We have a debt deal now that President Biden is going to sign. We're not going to have to worry about this until early 2025. They're taking this off the table for election year campaign season, and it makes sense. It's astonishing how fearful the market was of default, though. Credit default swaps on U.S. sovereign debt rose at its peak to 325. Now, this is the price of an insurance policy against default. So it went up to 325, and within the last few days, it's down to 10. So the fear out there was extreme, and the market is enjoying, the stock market, some of a relief rally associated with that fear going away. M2 officially now dropped 4.6% on a year-over-year basis in April. And we think that it will continue to accelerate to the downside. We think it'll be down 5% or more in May. I'll say it again. It is shocking to me that the Fed never talks about money supply. I was early in my career when Fed Chairman Volcker was focused on inflation, and all we talked about was money supply. So quite a big difference. So the question now is the Fed going to pause? And we keep getting different stories from different Fed governors and presidents and so forth. If you look at the two variables that the Fed has focused us on, employment, and you look at the headline numbers, including today's, we'll get into that in a moment, you'd say, no way are they going to pause. They're going to keep lifting rates. Employment is too strong. If you look at the details inside today's report, and maybe I will go through that now, you'll see that they may be having second thoughts. While the headline number, non-farm payroll, was up 339,000, I believe, much stronger than the 250 to 280,000 expected. Another number, which is actually a leading indicator of employment, but it's buried deeply into the report, is called household employment. So payroll employment is a survey of corporations. Household employment is a survey of households.
According to Woods, the surge in payrolls indicates that the labor market remains strong, which could present challenges for Federal Reserve officials. These officials were initially hoping to pause interest rate increases after the June 13th to 14th meeting. However, the increase in the unemployment rate may support their decision to pause. If labor market strength continues, though, they might consider raising rates in July. While the report initially appears positive, it also reveals that wages are not rapidly increasing. Instead, they are starting to stabilize. In terms of the Federal Reserve, this doesn't alter the likelihood of them skipping a rate hike in June. This decision would leave the possibility open for a rate hike at the next meeting, as Woods mentioned.
The Fed is going to have some interesting statistics, we think, in the next couple of months. And it's mostly because of what happened last year as opposed to this year. It looks like the CPI is settling into the 0.1 to 0.3 range. The comparison from last year for May was 0.9, and for June it was 1.2. That's month to month. So we're going to be dropping off some big numbers here, and we wouldn't be surprised to see the number in July, reported in July for June, to be around 3%. And to give you a sense of that, a year ago, June, the number on a year-over-year basis was 9. So 9 to 3 within 1 year's time. And we think the evidence is brewing that that number is going to continue down and probably will go negative. And when the Fed recognizes that that is the case, as we believe they will, there are all kinds of leading indicators, which I'll share with you in a minute, then it is going to change its tune. And by that time, we're probably going to see more increases in the unemployment rate. So today we got an increase from 3.4% to 3.7%. And the reason was that household measure fell 310,000, while the labor force, so the people out there looking for work, actually increased by nearly 150,000 people. So that's a 0.3 of an increase in the unemployment rate. The other negative piece of news from an economic activity point of view was that the work week shrank by 0.3%. And that has a disproportionate impact. It doesn't sound like a lot. 0.1 hours equals 0.3%, but it is a depressant on economic indicators. And in fact, if you look at total hours worked in the economy, they have essentially been flat to slightly down now since January. So there are a number of employment-related indicators that are suggesting weakness, even though there are others, like the JOLTS index, job openings soared in the last month. Initial claims started coming down again. The Challenger job survey, that one showed that layoffs surged 287% year over year. These are layoffs of, they're reductions in force, so a layoff of a group of people at the same time. So we're getting all kinds of conflicting indicators, which is, again, typical at turning points. And you'll know I've been using that phrase, turning points, for a while now. And one of the reasons for that is it does feel like we've been through rolling recessions, housing and autos, 2 negative GDP quarters in the first half of last year. And so it feels like this is one heck of an extended turning point in the economy.
President Biden delivered a rare Oval Office speech on Friday, praising the bipartisan agreement that successfully raised the debt ceiling and prevented a disastrous debt default. In his address, he emphasized the potential economic recession and job losses that were narrowly avoided. The president condemned the extreme voices threatening America's first-ever default on national debt, calling it irresponsible and catastrophic. The legislation, negotiated with House Speaker Kevin McCarthy, includes a 2-year debt ceiling increase and federal spending cuts. While not fulfilling all desires, Biden highlighted that it provides what the American people needed. This victory lap speech by President Biden comes after the Senate passed a bipartisan bill, ending months of tensions in Washington. The bill's passage averted a financial crisis that could have arisen from Republicans' refusal to raise the debt limit without stricter spending restrictions. Biden even considered using the 14th Amendment to ensure debt payments, but concluded it was impractical due to time constraints. The speech also showcased Biden's steady leadership, positioning him against more hardline Republicans engaging in partisan fights. Regarding market indicators, Cathie Wood noted that many companies are planning to reduce prices to attract consumers. Additionally, economic activity in the U.S. manufacturing sector continued to contract at an accelerated pace in May, with the ISM manufacturing PMI dropping to 46.9. This reading was worse than market expectations and put renewed selling pressure on the U.S. dollar, leading to a decline in the U.S. dollar index. The market's reaction to the debt ceiling bill remains uncertain, and further insights and predictions are encouraged in the comments section below. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.